Let's talk business. Commercial banks have until the 2nd of May to submit their feedback on the Central Bank of Kenya's consultative paper reviewing the risk-based credit pricing model. Central Bank Governor Kamau Thuge says the goal is to reform the model to address ongoing challenges in the credit market, such as high lending rates and unclear pricing mechanisms, by creating a market-driven framework for credit risk pricing. Jimmy Mbogo has more.
The ongoing review of risk-based pricing model for commercial bank loans continues to generate mixed responses, with banks and the regulator seemingly at odds. According to the CBK, unclear pricing mechanisms have resulted in high credit costs and reduced lending to the private sector. The CBK has attempted to address this by lowering the base lending rate. However, the Kenya Bankers Association argue that the impact of the changes in the central bank rate is only felt when the CBK implements monetary action such as liquidity injection or withdrawal to influence lending rates. Kenya Bankers CEO Raymond Molenje warns of a key risk in the current model, noting, and I quote, that the CBK may set the CBR and wait for transmission without necessarily implementing it to affect market liquidity. He further emphasized that banking sector focus should be on the interbank rate, which obligates the CBK to implement policy to align market condition with policy decision.
The reason I think that the CBR being the base rate is the right way is because it's also forward-looking. You see, the proposal by the banks is to average the last 2 months of the interbank rate. But as I've just told you, the interbank rate has been tracking very closely the CBR.
The CBK argues that under its proposal, banks would adjust their rates more promptly without relying on an average of past months when monetary condition may have been different. However, bankers argue that this shift towards CBR and a controlled margin K could amount to indirect interest rate capping.
And we also want that K to be also transparent. When it's broken down into the cost of operations, so in terms of lending, how much does it cost? What is the shareholder return? Yeah, and then finally the risk of the person. You know, if you don't pay your loans, obviously you'll be charged a higher rate.
This base lending rate is not just applying to commercial banks. They also those other financial institutions that also, in a way, will also be netted into this whole regime. So you find that they'll be spoiled for choice. These banks pretty much offering the same base rate, but also these other alternative financial institutions. So there could be also some opportunities for growth.
As the debate continues, experts believe that retaining the CBR as the base lending rate will be the most effective solution for the country's financial system. Jimmy Mbogo, Citizen TV, Nairobi.